UFP Industries. A high-quality cyclical, priced right at fair value. Overall verdict, yellow. Watch not chase. UFP Industries was founded in 1955 in Grand Rapids, Michigan, as Universal Forest Products, and renamed UFP Industries in April 2020. It designs, manufactures, and distributes wood and wood alternative products across three segments: retail, industrial, and construction. Retail brands include Deckorators composite decking and ProWood treated lumber, sold through Home Depot, Lowe's, and contractor lumberyards. In December 2024, 13-year CEO Matthew Missad moved to executive chairman, and Will Schwartz became the new CEO. Compensation is tied to return on investment, not stock price, a hard 6% threshold below which the incentive pool pays nothing at all. Price versus intrinsic value. Current price, $88.80. DCF base case, approximately $85 per share. Essentially fair value, with no real margin of safety. P/E ratio, 17.8 times trailing earnings, above this company's own 7-year historical average of 14.1. The bull case, if the housing cycle recovers faster, is around $110. The bear case, if the downturn persists, is around 55. Four numbers define UFP Industries. ROIC, 7.8% in 2025, the cyclical trough, down from 23.2% at the 2022 peak. Revenue compound growth, 6.1% over 7 years, masking a full boom-bust round trip. Net margin, 4.7% near the low end of the cycle. And free cash flow, $276 million positive every single year. Phase 1 Forensic Screen. 3 of 8 signals triggered, and all 3 trace back to one cause. Capex accelerated sharply even as revenue fell, from under 2% of sales to over 4%. That's a deliberate bet, building capacity while it's cheap during the downturn. Depreciation is running behind the new capex, exactly the pattern of real capacity investment, not the pattern of a company disguising operating costs as capital spending. Verdict pass, one of the cleanest forensic screens in this coverage series. Phase 2 Financial Analysis. Revenue tells one story, a full commodity and housing cycle. $4.4 billion in 2019, up to a $9.6 billion peak in 2022, as lumber prices and housing starts spiked together, then back down to $6.3 billion by 2025. Revenue and operating cash flow tracked each other closely throughout, no sign of manufactured growth. Margin trend follows the same cycle. Gross margin, 15.5% in 2019, up to 18.6% at the peak, back to 16.8% today. Operating margin compressed even more sharply, from 9.9% at the peak to 5.8% now, as fixed costs deleveraged against falling volume. DuPont decomposition shows both margin and asset turnover falling together into 2025. That looks structural at first glance, but leverage actually declined over the same period, from 1.43 times to 1.3. Management did not lean on debt to prop up returns as the cycle turned. This is a real, unobscured cyclical reset, not manufactured deterioration. Phase 3 Moat Assessment. 7 of 9 10-minute test filters pass. Verdict narrow moat. Return on invested capital ran above an estimated 10% cost of capital in 5 of the last 7 years, peaking at 23% during the 2022 boom. But it dipped to 7.8%, below cost of capital, at the 2025 trough. The source is moderate scale economies in a fragmented commodity industry. Real but never strong enough to push gross margin above about 20%. Phase 4 Capital Allocation. Verdict yellow. Debt discipline is excellent. Long-term debt stayed range-bound through the entire cycle, with acquisitions and buybacks funded from retained cash flow, not borrowing. But buyback timing has been genuinely mixed. Bought at 7 times free cash flow in 2022 and 2023. Excellent. Then near the 3-year price high in 2024. Poor. The record $433 million buyback in 2025 is the first real test of the new Schwartz and Cole leadership team. Phase 5 competitive dynamics. Verdict narrow. Scale economies are the one real power here, built continuously across 7 decades of bolt-on acquisitions in a still fragmented industry. That window has never fully closed, unlike a single moment takeoff moat. But it was also never strong enough to produce wide moat economics. Gross margin has stayed capped near 20% even after decades of compounding. Overall verdict yellow. Watch not chase. UFP Industries is a genuinely high-quality cyclical. A clean forensic screen, a nearly debt-free balance sheet that improved through the downturn, and management compensated on a real return on investment framework, not stock price. The moat is real but narrow, and the price doesn't offer a discount for that quality. The base case DCF sits right at today's price, with earnings still declining into 2026. A pullback into the $60 to $64 range would restore a real margin of safety on a genuinely well-run business. 10-minute quality test, 9 filters. Ever profitable pass all 7 years. Positive free cash flow pass every year. Consistent EPS. Fail earnings round trip to full cycle, up nearly 4 times then down 55%. Clean balance sheet, pass debt to equity as low as 7%. 7 of 9 pass. The fail is structural to a cyclical business, not a quality flaw. Share count, 60.1 million in 2019, 59 million by 2025, a modest reduction. The real story is 2026. Current shares outstanding have fallen further, to 56.5 million, as the buyback accelerated sharply after the fiscal year closed. Buybacks were sporadic through much of the cycle, 0 to about $96 million a year. Then surged to $433 million in 2025, exceeding that year's free cash flow of $276 million, funded from cash built up earlier in the cycle. Debt to equity ranged from 7 to 27% across the entire 7-year window. Genuinely low leverage. Interest coverage never dropped below 28 times, even at the cyclical trough. This is one of the cleanest balance sheets in this entire coverage series. 3 valuation methods, roughly converging. P/E ratio, 17.8 times above the 7-year average of 14.1. EV to free cash flow, 15.6 times also above the 7-year average. DCF base case, $85 per share, essentially today's price. Bull case $110, bear case $55. Fair value to buy with a real margin of safety is around $60 to $64.